Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again to another edition of All Things Financial. I ran across so many different articles and just different issues in the news over the past couple weeks. I thought I'd stop, take a show, and go through some of these different areas of interest that I think I wanted to share to everyone listening that might apply to some or all of you. So the first one was when I went in, and I was reviewing some old articles too. I was going back through, clearing out some old magazines, newspapers and all too. So some of these are fresh off the press and some of them are back to February and March, let's say. And the interest I found anyway, they were so interesting that I wanted to share these. The first one was I saw an article, and it's an editor's note actually in Money. And you can access it on the November 2014 issue of Money Magazine. But right in the editor's article in the beginning, it said, if Steve Martin calls you, hang up. And it has a picture of Steve Martin on it. And I'll show it to you there. So obviously I had to read the article, right? So I did, and I looked at the article, and it wasn't anything what I expected it to be. But well, here's what it says. It says, Steve Martin, and this is by Craig Matters, who is the managing editor that wrote this. And he says, Steve Martin telephoned me 3 times on a recent Friday. Not the comedian, banjo player, but a U.S., quote-unquote, U.S. Treasury official, leaving an urgent voicemail for him, informing him that he'd be arrested unless he called him back. Now, how weird is that? So you already know there's nothing good about this. So his article goes on to say, now the feds don't work like this, and I'm not a wanted man, etc. But he said he got bored one day, so he decided to listen to the message. And what he did, he called. Now, I'm going to tell you as a financial advisor, personal advice, don't call. But he did call. So what he got was the message, Kathy Brewer from Legal Affairs came on the line. And it was great to know he's saying that our public servants, are on the job over the weekend. And he says, tongue-in-cheek, the accents and slightly mangled bureaucraties placed them in an overseas office. So he knew these were foreigners. And what he said was, Kathy asked if I knew I had underpaid my taxes in 2010 and 2011 and could be arrested, and what did I want to do about it? So after about 5 minutes, Craig says he lost patience. Eventually, Kathy or her supervisor supposedly would have pressed him to wire money to make his troubles go away. So he just identified himself as a journalist and asked for an interview. And of course, promptly she hung up. You know, he goes on to say earlier in his career, he reported on investing frauds. And this one isn't sophisticated, but a lot of clients I talk to, even in my own practice, come to me or call me with, hey, I just got this offer, I just got this phone call, I just got this publisher's clearinghouse, whatever it is it legitimate or is it not? And usually we're able to see that there's a high risk factor when you're contacted by most apparently legitimate institutions. So it's a scary world out there, and I know it. We all know it. But he's going on to say in his article, in the past year, the Treasury Inspector General for Tax Administration has received more than 130,000 inquiries from people who have been contacted. So, and these aren't robocalls. These are real people calling. So it's very scary. What I want you to do, and what he's suggesting in the article, is spread the word. First off, if Steve Martin calls you, it's not really Steve Martin. We all should know that. But if anybody says they're from the Treasury Department or the IRS and they're calling you with a threat, what he wants you to do in the article is he says, go online, fill out the IRS impersonation scam form, and that's online at treasury.gov/TIGTA. So I'll give you that again. If you think anyone's calling and personalizing the IRS, and believe me, we're in times right now in November 2014, tax time is just coming up. So the income tax and IRS tax scams are just about to resurge again. They've been the last couple years. People are calling impersonating the IRS, saying they'll give you refunds faster, or what is your refund, or you did something wrong on your return and they just need you to verify information. So his caution is my caution. Assume that they're not real when you're contacted. Typically the IRS would contact you through letters, formal letters that would come from the IRS, and you can verify their address. But what he's saying in this article, Craig Matters is saying, go to that website also, and you could file an IRS impersonation scam form. Again, that's treasury.gov/TIGTA. All right, now I ran into another article. I was in the Wall Street Journal. This was Tuesday, November 13th, 2014. And what I saw caught my attention there was an article that said many face new normal, part-time pay, full-time bills. And the article goes on to say, it goes through in the article that through no fault of their own, people are being downsized or scaled down the number of hours that they're being able to work, and because the employer is cutting back hours. In some cases, they're actually also putting signs out that they're hiring. So the one example in the article showed, hey, there's an employee from one of the companies that says, why are they putting us on 23 hours a week? We want more hours. They say we can't have more hours, and yet they're hiring new people. So it looks like we may have a little bit of a problem with people having to pay all their bills with a part-time job. And then we're running into a situation, what does a person or family do? Are they now going out looking for 2 part-time jobs to try to replace their older full-time job? So we have a little problem there in the economy still. Be careful with that if you're looking for a job, especially if you're looking for a full-time job, but it's hourly. So be a little bit careful about the trend of the employer that you're looking to on whether they have cut hours, and here you're now getting hired with them, hoping to get put on full-time in case your likelihood of being full-time is very much more limited than you were hoping it would be. You might want to choose a different employer. So I wanted to point that out to you. It might be a strategy that some companies are finding to hold people as part-time because of the health care law or other benefits that they don't want to be required to have to comply with. And that leads me into the next article, also on November 13th, 2014 in the Wall Street Journal, and that it's pertaining to healthcare and healthcare costs. What we have is, it says surprises in health re-ups, which is really renewals, re-upping in the new plan. And it's stating in this article that low-priced plans can make tax credits smaller for those who don't shop around. The message of this article goes on to say, and I'll read you excerpts from it, but it goes on to say, if you don't shop, and most of us don't, when we get health care and we get it in place, we typically don't shop anymore. We're done. Or we think we're done. But with these new programs, every year, they're changing drastically. Well, what's happening is we get these new low-cost providers coming through the states. The subsidies the government subsidies that are helping offset some of these premiums are being reduced if the premiums offered by the companies are discounted or a lot less, because the subsidies are based on how high the premiums are. So here's the article. It says it's by Louise Radnofsky. This is in the Wall Street Journal, November 13th. In a twist, an influx of lower-priced health plans on healthcare.gov, and you all know that site, or many of you do, could lead many Americans to pay more for coverage next year thanks to smaller insurance tax credits. So again, an influx of lower-priced health plans could cost you to pay more. So the article goes on to say a handful of insurers in 14 states, and guess what? Yes, Pennsylvania is one of those states in jeopardy of this, are offering aggressively low premiums on the federal insurance enrollment site, which reopens Saturday, folks. That's today, the date of this show, in a bid to undercut big rivals who snapped up customers last year. So what we have is a bunch of sore losers, companies who lost enrollees last year because big companies came in with big discounted plans and they stole all these customers away, and these other healthcare providers want the customers back. So they're coming through with steeply discounted discounts, wanting to get everybody back. But the article is pointing out, watch out, what your net premium will be after the federal subsidy. What they're saying in the article is the move is pulling down the value of federal tax credits that consumers get to offset the cost of their coverage under the Affordable Care Act. So while your premiums are lower, you're getting less subsidy. You may be paying more than the higher premium with a higher subsidy. And this is all new for all of us, folks. So the article then goes on further to say, in a study to be released Thursday, Wakely, which is one of the sources they're quoting in here, found that consumers in Pennsylvania, New Hampshire, and Mississippi are expected to see the sharpest decrease in their tax subsidy as a result of new low-priced plans. And the study looked at prices in the largest county in each state. That's what it did. So you go through this article and it says, shop every year. You are typically not used to shopping, but it goes on in the article to share somebody's premium was, initial quoted premium, let's say, was $289 a year for a 40-year-old, but based on income, you know how the subsidies are offset, based on the income of about $24,000 a year for that person. The subsidy for 2014 came in at about $168, which means this person does not have to pay $168 of the $289. So they were only paying $121 a month after the subsidy took care of the rest. And they're saying after these new low discounted plans, an example of this, the plan might cost $251 a month, but the same 40-year-old might only get a subsidy now of $128 a month instead of $160, and that means they're paying a higher portion of the premium, and that's what we're trying to avoid. So this is tough. I mean, this is difficult to try to navigate this. So all I implore everyone to do is get out there and shop, because the article goes on to say a lot of people are going to be blindsided by not renewing or re-upping, thinking because you're already in a plan, it will automatically renew. Some of them will automatically renew, and some of them won't. So you could be left without coverage, or you could be left with a much lower subsidy than you had last year for the same plan and be paying a lot more and didn't know it. And had you known it, you would have gone out and shopped all around and jumped companies into another new, much lower premium, including the lower subsidy plan, than what you're going to be stuck with if you stay where you are. So shop. That's the advice of the article. Shop it. Shop it every year if you're playing ball under these new plans. All right, now I come into the next article, and the next article is online. I looked at marketwatch.com, and that's a website, and I look at that often to see what's going on there. And the article that was on there, I'll show you that one too, and look at that headline. That headline says, "Don't make the mistake that cost Boeing employees $98 million. And that's by Paul Merriman. So obviously, again, I have to check out this article. And if it's of value, I have to share it with all of you. So I did. And I went in and checked out the article, and it said, investors saving for retirement face many obstacles, including high fees, poor investment options, vanishing pensions, and it goes on to say, however, when workers pass up an offer of essentially free money with no strings attached, it's hard to identify a scapegoat other than the workers themselves. So it's like, who can we blame for this? We can only blame ourselves. So I'm going on in the article. Come on, what are you talking about? I'm trying to look and see. Tell me what you're talking about. And here it is. It says, a few weeks ago, I, the writer, Paul Merriman, learned that more than 56,000 Boeing employees fall into that category. Well, what category? Apparently, they'd rather give billions of dollars to Boeing shareholders than keep the money for themselves. I have to tell you, folks, I'm still curious as to what he's talking about. So he says, mighty generous. And then he explains it. He says, I came across a notice to Boeing employees informing them that they collectively left $98 million on the table in 2013 by not taking advantage of matching funds in the company's 401k plan. And bingo, I knew what he was talking about. He's talking about people that work for a company that offer a 401k plan with a company match at some percentage. If you contribute as an employee to your own retirement savings through their 401k plan, they will match you dollar for dollar or 50 cents on the dollar or whatever, some portion of your contribution up to a certain percent. So therefore, anyone who's not taking advantage of putting money aside through their 401k is obviously then not getting the match which the company gratuitously would have been paying on top of your contribution. And I got it. I knew what he was saying. And I thought, that is a profound article. I run into people, you run into people, everyone knows people who say we can't afford to contribute to the 401k plan. This article is saying, look at the money you're leaving on the table when you make that usually mistaken decision. So he goes on to say, according to this report, approximately 8,400 employees of Boeing declined to participate at all in the program last year, and another 48,000 didn't contribute enough to receive the maximum company match. Boeing didn't respond for comment, he says, but my hat's off to them for being so forthcoming with their employees. Now think about that. We have an employer who is communicating, please let us help you and give you money. They don't have to do that, folks. So that's why Paul Merriman's taking his hat off to them. And boy, we do too. All of us. If our employer said, hey, I want to give you money, you have to contribute first, and I want to match what you do, so it's a partnership type thing. But we have money to give you with no restrictions. That, yeah, we'd be kind of foolish, we would think, to pass those offers up of free money. So then he goes on and says, it's startling to realize that about a third of all Boeing employees are voluntarily taking less pay than the company wants them to have. And when you think about it that way, that's an interesting way. They're actually taking less pay than the company's trying to pay them. And it goes on to say, to receive the full company match, employees would only need to contribute 8% of their base pay. Boeing matches those contributions at the rate of an extra 75 cents on the dollar. In other words, set aside $1 and get an instant one-time only return of added to your account of 75%. That's a 75% instantaneous return or bonus added to your account just by making the initial contribution. And then Paul goes on and gives an example and says that's the equivalent of a 6% raise, something I doubt employees would turn down if it were offered to them in those terms. And then he says, I used Boeing as an example, but they're hardly alone. A survey conducted this year by Harris Poll for Wells Fargo found that a middle-class U.S. residents aged 25 to 75 have set aside a median of only $20,000 for their retirement. 1/3 of them reported they are not contributing at all to a 401k or IRA or any other retirement plan. That's far worse than the Boeing statistics. And it says of those who are saving, the median amount reported was $125 a month. Finally, about half of those who were in their 50s told the pollsters they expect to work until age 80 because they will have inadequate savings to retire. You know, the earlier you start, the younger you are, the easier it gets because it's less pain of taking money aside that hopefully you won't miss in the 401k plan. So I again implore everyone listening and watching to reevaluate your retirement savings programs and your retirement levels that you think you'll need to retire on. Well, how do you know? You consult a professional financial planner and you sit down with no commitments and you ask them, how can I evaluate what I will need to be able to retire by when I am hoping to be able to retire? And they'll reevaluate your situation and help you analyze what should you be doing and not make mistakes. And it does not take, in many cases, a whole lot of money to make changes. It's like shooting an arrow to a target, a very, very small change at the point of the shot. Just a very small angle change can put the arrow off target by a foot or 2 feet or miss the target entirely. So by being precise very early in its path, you could be precise at the end mark you're trying to hit. So I wanted to share some of those articles for you today. Again, we're out of time. I'll be back again next week. Thanks for tuning in and listening. I appreciate you listening to All Things Financial. We'll see you again next week.
You've been listening to All Things Financial with your friend with the answers to all financial matters, Jack Driscoll of Driscoll Insurance and Financial Services. Securities and investment advisory services offered through SagePoint Financial Incorporated, a registered broker-dealer and registered investment advisor and member FINRA and SIPC. Driscoll Insurance and Financial Services is not affiliated with SagePoint Financial, Inc. or registered as a broker, dealer, or investment advisor. You can reach Driscoll Insurance and Financial Services Incorporated at 412-833-1500, and they are located at 2738 South Park Road, Bethel Park, Pennsylvania, 15102.